gentlemen, this is Alex, Senior Account Executive at GDMFX with the morning European session outlook. We'll start with the North American markets. US stocks on Friday suffered the worst slide since the UK's surprise decision to exit from the EU, as hawkish comments from Fed officials affected harshly the bond and equity markets. Friday's broad sell-off puts the Dow at a weekly loss of 2.2%, the S&P 500 at 2.4% loss, and the Nasdaq at a 2.4% decline. Boston Fed President Eric Rosengren, a voter this year on the Fed's interest rate setting board, said on Friday that the U.S. Central Bank could resume gradual rate increases as the risks facing the economy are more in balance, reigniting Wall Street's fears about the end of easy money policies. This also helped boost the dollar quite a bit. Canada had mixed data on Friday, with the unemployment rate coming in at 0.1%, worse than expected at 7%. However, the net change in employment was quite positive at 26.2 thousand, which is 11.2 thousand better than expected. The participation rate was 0.1% less than previous at 65.5%. The Dow ended 43 points down, Nasdaq's 123 points down, Dixie down to 95.28. USD Canadian dollar was 125 pips up, against the Swiss franc 32 pips up, and against the Japanese yen 36 pips up. Today's events are just a couple of speeches from Lockhart and FOMC member Brainard as well. For the week, we have on Thursday retail sales month on month, and Friday CPI data year on year, and Reuters Michigan Consumer Sentiment Index. That's all for North America. Onto the European markets. Last week, the ECB offered no surprises in its statement, leaving its main lending rate at 0% and its deposit rate at minus 0.4%. In a statement identical to its July one, the ECB said it intended to maintain its 80 billion euro a month asset buying program through at least the end of March 2017 and beyond if necessary. On that line of thought, Draghi will be having a speech tomorrow, and we'll be looking forward to hearing what more clues he can give regarding the monetary policy. We'll also have the ZEW survey for economic sentiment in the European Union on that day. On Thursday, the SNB will have an interest rate decision and press conference. That's Switzerland. All right, on to the UK markets. We had the consumer inflation expectations come out 0.2% better than previous at 2.2%. And we had some trade balance, non-EU, 490 million pounds worse than expected at negative 4.2 billion. And the goods trade balance, 160 million worse than expected at negative 11.760 billion. The pound ended the last week with a 0.3% drop versus the dollar, putting an end to a 3-week upward run. The sterling has outperformed all but one of its 16 major rivals this month due to strong data from services and construction. Sterling's calm movement will be tested in the coming week, as the Bank of England will have their monthly meeting, from which the public will get a view on how the MPC is assessing the post-Brexit economy and the effects of the measures of the Bank of England undertook earlier. Mark Carney expressed the view that the chances for a recession in the UK have fallen, but the Bank of England remains ready to add further stimulus if needed. Price swings, especially versus the dollar, are expected also due to a large batch of data that will be released this week. Inflation readings, employment and earnings data, and retail sales can trigger the sterling to spike or sink versus the greenback. The FTSE 100 was 119 points down, closed at 67.32 on Friday. And this week's most important events are the CPI year on year, the core CPI year on year, the Bank of England Super Thursday minutes, and monetary policy report. All right, on to the Asian and Pacific markets. Japanese core machinery orders unexpectedly grew for the second straight month in July, government data showed on this morning, a possible sign of gradual recovery in Japan's economy. Core orders, a leading but volatile indicator of business investment, rose 4.9% from the previous month. The Cabinet Office said the result was better than a 3.1% drop expected by economists surveyed by the Wall Street Journal and the Nikkei. On a year-on-year basis, core orders in July also increased 5.2%. Following the better-than-expected result, the Cabinet Office upgraded its assessment of machinery orders, saying they were showing signs of recovery. Previously, they were described as stalling. The report said that an increase in demand from non-manufacturing sector had fueled orders. Asian shares started the week notably weaker, as investors' anticipation continues to build regarding a pause in global central banks' easing policies, which have helped prop up asset prices. The Nikkei 225 was 328 down on Friday and already going down this week. For this week, on Tuesday, we'll have Chinese retail sales year-on-year, Chinese industrial production year-on-year. On Wednesday, Japanese industrial production year-on-year and month-on-month. And on Thursday, Japanese foreign bond investment and foreign investment in Japan stocks. And also from New Zealand, we'll have the GDP year-on-year, unemployment change, and unemployment rate. All right, and on to commodities. We have the Baker Hughes oil rig count. The drillers added oil rigs for a 10th week in the past 11. It was the longest streak without rig cuts since 2011. Crude prices fell over 1.5% on Monday after U.S. oil drillers added rigs to look for new production as producers adapt to cheaper crude, with speculators cutting positions, betting on further price rises. Gold prices fell for the third straight session on Friday, pressured lower by a stronger dollar and renewed expectations for a near-term interest rate hike by the Fed. The S&P 500 index had a range of 59 points, down to 2,110 now. Gold had a range of $13 down to $13.29 now, and silver had a range of 76 cents at $18.97 now. Crude oil had almost $2 range, down to $45.10, and natural gas is trading at $2.82 at the moment with a range of 6 cents. And that's all. Thank you for the attention. Goodbye.